In accounting, organization is key, and one of the surefire ways to stay organized is by keeping a written record of all transactions. In accounting, these records are known as journals, and just like a journal you might have kept as a child, each transaction recorded is known as a journal entry. Entries are the only means in which accounts are populated with economic and descriptive data of events of the organization. They are made for regular daily transactions as well as adjustments that must be made to various accounts that require entries to change those balances appropriately. Each entry must balance on its own merit, meaning we have the same amount of debits as we do credits for each entry. Now, back in the Stone Ages, accountants used to handwrite their journals on paper. However, once computers became commonplace, they put paper tablets out of commission. Each journal entry should follow the same formula. At the top left is the date of the transaction. Just below that, write the name of the account that will be debited, and below that, indent to the right and list the account that will be credited. Now, let's go over to the right-hand side. At the top are two amount columns. To the left is the column labeled debit, and to the right is the column labeled credit. There is space below for each amount that corresponds with the account names on the left-hand side. And finally, below all of this is space for a brief description of the transaction, whatever it may be. Fun tip: when writing in the amounts on a journal entry, the dollar sign isn't used, as it's understood that every entry represents dollar amounts. Some journal entries only have one debit and one credit as a result of the business transaction. However, when an entry has multiple debits and/or multiple credits, it is known as a compound entry. No matter how many debits and credits are involved, just remember, for each journal entry, the sum of all debits must equal the sum of all credits. Let's think of a scenario. On July 1st, FAC Electronics sells shares of common stock to investors for $100,000 cash. How would this be written out as a journal entry? Well, first, we put the date, July 1st, at the top left. Then, we place cash as the first account below the date, followed by common stock as the account right indented below cash. Over on the right-hand side, we place $100,000 under the debit column, which corresponds with cash. This is because an increase in FAC Electronics assets reflects their debits. We also place $100,000 under the credit column that corresponds with common stock. This is because stockholder equity increases as credit. And finally, we place a brief description of the transaction below on the left-hand side. We can describe this transaction as issued common stock for cash. So there you have it. Even though they get more complicated, this is the accepted way to write out a journal entry. Just like a good business, start small and get bigger as you gain more knowledge.